And Alex, you're a private money lender, right?
Yes, that is correct. We are a direct lender. We offer our commercial bridge loan financing nationwide.
Okay, awesome. I love that. So would you just mind giving me a definition of what a bridge loan is?
Yeah, so a bridge loan is a loan solution that can be used to help bridge the gap between where the property is or where the borrower is, financially to where they need to be. And so, ideally we're looking for clients who get turned down from the conventional permanent financing. And that's where the bridge loan can come into play. Now, there's multiple reasons why a client can get turned down from a permanent loan, and that could be whether it's low occupancy on the property itself, maybe that the property has some deferred maintenance causing the low occupancy, also credit score requirements. Other reasons could be quick closes. Bridge loans have the ability to be closed quickly compared to permanent financing.
I noticed nothing that you mentioned had to do with a borrower trying to get a loan for their primary residence. So basically, all the loans that you're discussing with me right now are business purpose loans, right?
Yes, that is correct. Business purpose.
Okay, so it's not about me trying to, purchase a property and I can't qualify because I don't make enough money, and then I request for you to give me bridge financing. It's basically me trying to buy an investment property of some sort, whether it's residential or multifamily, and I'm coming to you for bridge financing. So basically, like you said, either the property is inhabitable, which means that it wouldn't be able to be financed on the conventional channel, and so it would have to be bridge, basically meaning you're giving me money to fix up the property so I can turn around and go get a conventional loan. Is that accurate?
Yes, that is accurate.
Sounds great. So I have a lending scenario for you. Ironically, it's Friday for me. Obviously, I'm out of the office, but you called and I thought this would be a good opportunity to share this particular content. So number one, you may or may not be lending in Nevada. Do you lend in Nevada?
Yes, we lend nationwide, just outside of any rural areas.
Okay, great. It's not
good population.
Yeah, it's not a rural area. So okay, so see, there you go. First question. Some lenders lend. I'm in LA, California, so you got to ask because some of them don't do business out of the state. But good thing you do. Now, moving on. This particular property is mid-construction. Do you do any mid-construction financing?
Unfortunately, we don't. We don't do mid-construction. Yeah.
Okay, so we failed in category number 2. Basically, do you want to tell me why you don't do mid-construction financing?
Yeah, mid-construction, to a lender's eyes, it looks like maybe some poor planning, running out of money in the middle of a construction project is a red flag.
Sure.
For many lenders. Yeah, especially us. We can do construction loans, but not something that where projects run out of money halfway through.
Got it. So basically, just a small recap. If I pitched you a construction loan, meaning that the borrower purchased a property and they need, rehab funds or even whatever, new construction, that would be okay because I could actually give you the value of the property that they purchased, and I could give you a budget for a foreseen rehab, and you could put those two numbers together and potentially give me a loan up to 70%, most typically, right? Loan to cost with fund control, meaning that you'll give me up to 70% of the appraised value with fund control. So this way you safeguard the investor. You know what the property is going to be worth after the fact, and then you slowly give me money and make sure that the work is completed until we get to the finish line. Is that accurate?
Yeah, that is accurate. Lenders can typically go up to 70% LTV. With us specifically, we're looking more like 65 to 70%. And that's also based on the after repair value.
Sure.
So our maximum loan amount cannot exceed 60 or 65% of the future value.
Sure, so we're talking 60-65% of the future value, but potentially 70% of the loan to the cost of the project, right?
Yes, that is correct.
Okay, but in this particular case, the reason you're tapping out, you're doing the Shark Tank thing, saying you're out, is because these guys initially had a budget, they had a lender, now they need to get refinanced out of that particular loan scenario, specifically because they failed to meet the terms of the budget. Something happened within the construction where they either ran out of time or ran out of money, meaning that the repairs cost more, so maybe they lacked experience and they didn't know how to calculate the repairs of the property, or the build out, or they didn't have enough experience where they couldn't meet the timeline, or there were unforeseen items that they didn't know about. And then for all those reasons, you think that's a big red flag and you don't want to get involved in that, so you're out, right?
Mm-hmm. Yep, that's correct.
Okay, very good. So guys, this is a typical conversation with a private money lender. Obviously, there are different type of lending scenarios. Alex, what kind of lending scenarios do you entertain? Single family, multifamily, construction, pretty much across the board and out of state, right?
Yeah, so again, nationwide, but really our bread and butter is non-residential commercial real estate. That's where we found a niche, being underserved, and we want to fill that niche. So we do loan amounts from 500,000 to 18 million. Now, circling back on the construction loans, I did want to mention also, it might be important to ask whether the lender charges Dutch interest, which means
Sure.
that the interest getting paid on the full loan balance, not not just what's being used for from the draw. So lenders like us, we're not as aggressive when it comes to construction financing, so we do charge Dutch interest. The other type is, I believe it's called New York interest, and that's where the lender will only charge interest on the amount that you actually withdraw from the escrow account.
Right. So that's a big thing. Because basically you're securing funds going to third party fund control. The investor at that point is out because he gave 100% of the funds, meaning that he's charging 100% of the interest on 100% of the loan amount. So that, is just something to keep in mind, because you're thinking to yourself, well, say the rehab's 500,000, I only draw 50,000, I'm going to pay interest on 50,000. That's not the case. You're talking about paying interest on the full amount.
Yes.
Alex, I really appreciate it. Thanks for letting me record the segment. I guess I'll catch you on the next lending scenario, but totally appreciate it.
Yeah, Zevi, it's always a pleasure. I appreciate it and look forward to talking with you again.
You got it, brother. Have a beautiful weekend. Take care.
Thank you. Likewise. Thank you.
Bye.
Bye-bye.
Okay, guys, so there you have it. That's a hard money lender for you. We ran a financing scenario, basically mid-construction. Obviously, they weren't interested in the deal, but that's what it takes as a loan broker to shop a financing request for a potential borrower. You're getting a glimpse of what the day in the life looks like. So hopefully you enjoyed that. Hopefully you took away some value from that. And if you did, you know what to do. Please give it a big thumbs up. Subscribe to my channel if you haven't already. And I will totally catch you on the next video. Thanks for watching. Bye.